You get your paycheck, you have a little extra cash, and then you're stuck thinking, do I throw this at my credit card? Or do I put it into stocks, crypto, real estate, whatever? Today, we're going to break it down. Simple, real, and no fluff. First, let's get real about debt. Not all debt is created equal. Credit card debt? That's toxic. We're talking 20% to 25% interest. It's like a leech draining your wealth every single month. Then there's student loans, car loans, mortgages. These are usually lower interest rates. Not great, but not immediately life-threatening. So, the very first step is to know what kind of debt you have and what it's costing you. If you're paying 20% interest on a credit card, but your investments might make you 7% to 10% per year, guess what? Paying that debt is literally a guaranteed 20% return. There's no stock, no crypto, no magical investment that's going to beat that in a safe and reliable way. So yeah, high interest debt equals enemy number one. The opportunity cost of waiting, but here's where it gets interesting. Let's say your debt is manageable, like a 3% student loan, or a 5% car loan. Now we're in a gray area. Because while you're aggressively paying off that low interest debt, you're missing out on potential investment gains. Historically, the stock market returns about 8% to 10% per year over the long term. So if your loan is only costing you 3% or 4%, but your investments could earn you 8%, you're leaving free money on the table by not investing. This is what we call opportunity cost. So, what's the smart play? It really comes down to balancing two things. Mathematics, psychology. Mathematically, if your debt interest rate is higher than what you'd expect from investments, pay the debt first. Simple. But if your debt is cheap, money, low interest, then investing makes more sense long term. But here's where psychology kicks in. Debt feels heavy. For a lot of people, carrying debt is stressful. It's emotional. Some people sleep better knowing they owe nothing, even if they missed out on a few extra investment gains. So ask yourself, are you the type who wants absolute peace of mind, or are you okay with calculated risk for higher rewards? The hybrid strategy, best of both worlds. Now, most financial advisors will tell you, do both. It's called a hybrid approach. Here's how it works. You make your minimum debt payments. You throw extra money at high interest debt, like credit cards. At the same time, you start investing consistently. Maybe it's 10% to 20% of your income. That way, you're crushing bad debt while still letting your money grow through investments. This is powerful because of compound interest. Every dollar you invest today snowballs into much more over time. Imagine this. $500 invested today could become $4,000 to $5,000 in 20 years. But if you wait until your debt is gone to start investing, you lose that valuable time. Real talk. Emergency fund first before you even get to investing or paying debt. Make sure you have a basic emergency fund. 3 to 6 months of expenses saved up. Because the last thing you want is to be debt-free, invested, and then get hit with an unexpected expense, and go right back into debt. Think of it like this, your emergency fund is your safety net. Without it, you're walking a financial tightrope. The dangerous trap of, I'll invest later. A lot of people think, I'll invest after I pay off all my debt, and that sounds responsible. But here's the danger, life happens. By the time you're debt-free, it might be 5 or 10 years later. You've missed out on years of potential investment growth. Time in the market beats timing the market. Every single time. So don't fall into the trap of waiting forever. Final verdict, invest or pay debt? Here's the golden rule. If your debt is above 7% interest, attack it first. If it's below 5%, prioritize investing, but still chip away at your debt. Between 5% and 7%? Hybrid strategy. Balance both. And don't forget the emotional side. If debt gives you anxiety, it's okay to prioritize paying it down faster, even if the math says otherwise. Peace of mind is priceless. But never ignore investing completely. Even small amounts grow big over time. Bottom line, it's not really invest or pay debt. It's invest and pay debt smartly. The goal isn't to be debt-free as fast as possible. The goal is to build wealth while managing debt intelligently. So next time you get that extra cash, don't just default to one option. Run the numbers. Think about your goals. And make your money work for you. Because in the end, that's the real win.